All right, everyone. So I'm going to give you a little bit of a game plan for the week ahead. It's Sunday, April 14th. Tomorrow's Monday, the 15th. And, last week we had some good opportunities pretty much every day. I ended up being green on, let's see, 4 out of the 5 days last week. I had 2 days where I was over my goal, 6,000 on Tuesday and Wednesday, came up a little short on Monday, Thursday, and then was red a little bit on Friday. So this is my P&L in the last 30 days. Go out a little further to 60 days. It'll look a little better, 60 days. More or less, though, you could see in the last month, I had this drawdown, a recovery, and now I'm back at the high. About $247,000 of profit in 90 days. Not bad, but, could be better. So anyways, last week we had some good momentum on, interestingly, lower price stocks. That was kind of the theme. We kept having these lower price stocks that were just grinding. INDO is kind of an example of that. On Friday, INDO pops up. And one thing I'll say is that, let's just look at these moving averages here for 1 second. So we hide these moving averages, the 200. There are definitely traders that might have bought into this move right here, not realizing the position of the daily 200 moving average. And it's like, if the stock is under the 200, a lot of times, and it's extended coming to that level, it is not going to be able to break. And certainly that was the case with this. It came into those levels, was not able to break, and then as you can see, Friday, it was able to push through. So Friday started strong, pushed through, and ended up going all the way up to $6. Now, this is an energy stock, Indonesia Energy Corp. It is one that we traded. I guess it was during the pandemic. There was a period there where oil prices went crazy, and anyways, some of these stocks moved up. But this was a little bit more of a grinder as well. So when I'm talking about a stock being a grinder, the way I would describe that price action is the price at breakout points. So let's just say we'll look at the 1 minute. The 5 minute is always cleaner on a grinder. You look at the 5 minute, you're like, golly, that was pretty solid. But on the 1 minute is where you get chopped up. So let's see. We'll go back in this area. Even this right here, like this is a 1 minute micro pullback right there. It pops up, it pulls back, it pushes higher, and then it kind of drops down. It pushes higher, and then it kind of drops down. It starts to come up again, and then it kind of drops down. It tries one more time, drops down. And you get yourself really frustrated. Then it finally starts to pull away, it drops down. Here we go, now we're going for real. And then it drops down. And now we're going. And then you look at it, and you're like, my God, I got in, I got out. I got back in, I got stopped out. I got back in, I got out with almost nothing. I got back in, I took a loss. I got, back in here, had a small winner, but then it drops. I got back in here on this micro pullback for the break of 450, and then it drops. I get back in up here, now it kind of pulls away. I get back in on this 1 minute micro pullback, and I get stopped out. And it just feels like you end up churning a ton of commissions. And the next thing you know, you look and you're like, this thing keeps going higher. And so grinders end up being easier to trade using a 5 minute chart, where you try not to get chopped out by the 1 minute price action. But that's easier said than done, because look at some of these 5 minute candles, how big they are. It's like a dollar a share. So it's pretty rare on a $5 stock for someone to be comfortable being up a dollar a share and then going to break even, or being up 50 cents a share and then down 50 cents a share. We just don't really like to manage our risk like that. So anyways, that was a little bit of a challenge earlier in the week. And it was a challenge again on Friday. I didn't trade INDO on Friday because by that time I'd already basically hit max loss, and I was like, very close to it. And then I had a nice recovery, and I was like, you know what? Let's not overstay my welcome. This, by the way, was my equity curve for Friday. Got green, and then red, and then had a nice recovery trade. And I was like, at that point, let's not push it. It's not worth it. So anyway, so I didn't trade this. I just didn't want to risk going back into the red, which was fine. That was the right move, because My best days start strong and then just continue. And, I knew Friday wasn't going to be one of my best days. So at that point, it was just damage control. Just try to minimize the loss and maintain composure. And I did a fine job with that. So anyways, so I would say the theme for last week was lower priced grinders. If we look at my P&L just for last week, we'll just pull this up for a second. So, and just to kind of gauge like what was my performance last week. Performance last week, $14,000 gross, a little bit less after fees and commissions, but that's fine. And profit loss ratio about 1-to-1. $600 winners, $600 losers. Accuracy 72%. That's all pretty good. This is a small average winner for me, relatively speaking. My average winners are usually closer to like $1,500, $2,000. But anyways, performance by price range. This is what I really wanted to highlight. It was all on stocks between 2 and 5, which is fine. But that was just the theme for last week. 5 to 10, a little trickier. 10 to 20 had a little bit of profit, but just not as much. So, and this was my distribution of trades. So I traded a lot of stocks, as you could see, between 10 and 20. I mean, I had a number of trades, but it didn't end up producing profit. These ended up just chopping me out. I made some money, lost some money. Over 20, nothing in terms of profit. So the performance ended up being that I made the most on stocks between 2 and 5. And if we look at the individual stocks, we had LASC, midweek, WNW, and Rent. So LASC, this was a grinder. Interesting because the float is pretty low, but on this day it was a grinder. 100 million shares of volume. That's a lot of volume. So it's pretty thickly traded, and the volume is tapered down a lot. We went from 100 million shares 3 days later. We're at 400,000 shares of volume on the day. So it's also a good reminder not to be a bag holder. When these are in focus, they have a ton of volume. But once they're out of focus, well, people stop caring. So that was LASC. Put in a decent move here, but then became kind of choppy. We had WNW. This one was a real grinder on, I think it was Tuesday. Yesterday Friday it had 500,000 shares of volume as well, whereas it had 55 million on the day it made a big move. This one put in a big move here, kind of a round trip. Didn't end up holding super well. AUUD was earlier in the week. Yesterday, the volume was 300,000 shares. So, these have their moment in the spotlight, and then traders shift gears. And it's because these are the days that they have news. So the routine each morning is to look for stocks first of all, it's to look for stocks that are moving higher, which means the first thing I look at each morning on my phone before I even get out of bed is my top gainers scanner. I'll be doing the same thing tomorrow morning. So I pull up the leading gainer, for instance. This one's MI. I'm pretty sure this was a reverse split, so I disregard that. Second leading gainer, TPET. It's a cheaper stock. All right, so I know I'm not a fan of these cheap stocks, but I see it. Next one down, PXMD. Also cheap. Next one down, INDO. This one, okay. So then I try to figure out what's the catalyst that's driving this. Is there something obvious that's moving it higher? If I can figure out what that is, then I check the daily chart. What's the position of the 200 moving average? Are we above it or are we below it? All right, this is a critical level of resistance. Then I'm looking to the left, looking this way, and I'm looking up. Where nearby gaps, windows, areas of resistance, right? So maybe there, maybe there, maybe there, maybe there. So I can draw my trend lines and start to snap them on, all right, maybe have like an issue like up there, something like that. And then from that point, I'm looking at my 10-second and my 1 minute to actually time my entries, and I'm pulling up the level 2 so I can understand the dynamics of the way it's really trading. Once I pull up the level 2, that's when sometimes I'm like, ooh, it's thickly traded. It's stacked on the bid, it's stacked on the offer. Once I pull up the level 2, that's when I see whether or not it's easy to borrow or hard to borrow. That's when I see whether or not it's on short sale restriction. So the level 2 is I don't need to look at any of that until I've already kind of vetted that I'm okay with the price. I like the volume. I like the float. I like the catalyst. I like the chart. I could like all those things, and then I check sort of that final step, just like, a checklist. And I'm like, ooh, you know what? Not a fan of that final step. By the way, if you want that checklist and you want a little bit more detail about my strategy, I'll put a link to my micro pullback PDF that you can download in the top of the comments and in the top of the description. So you could download that and you could start utilizing that in your own trading. For the most part, last week I was trading micro pullbacks, which is you have a quick move to the upside like this, you have a momentary pullback like this, and then as soon as the candle makes a new high, boom, next leg up. This works really well when we have breaking news. So we have breaking news, that sends the stock up, then we get a micro pullback, momentary pullback, and then next leg higher. So that was the way I was trading for most of these last week, and that paid off quite well. Although, as I said, some of the grinders I left a little on the table by not trading as aggressively as I could. So in terms of the continuation scan, I don't really I haven't gotten any solid trades off the continuation scan recently. A lot of these that have big moves are not holding up super well. GCTS, this one made a big move, but is at the bottom of its range. It's underneath the 200 moving average. I don't see a lot on that. ZPTA, this one's a little too cheap now. Again, a really big drawdown, pullback. So VVPR, we got a couple trades on that, but I think now it's sort of pulled back too much. I don't think the market is quite hot enough to depend on first daily candle getting a lot of continuation. It's a little cooler than it was a few weeks ago, which is fine. That's just the cycle that we're in. So I don't think I don't think it's going to do much good to build a watch list off of the continuation scanner. It's fine to look at some of the stocks. CADL, I could kind of see it maybe grinding higher. It's holding up all right. Floats a little higher, but it had a good catalyst. I don't know. Rent, this one obviously put in a big move and had a nice move again on Friday. This was my biggest loser and my biggest winner on Friday. So it wasn't easy to trade, in other words. Am I going to want to trade it more? Probably Monday morning. I don't want to even look at a stock that's over $20 a share. Because here's the problem. These higher price stocks, I tend to make mistakes. It's so easy to take just a little too much size and then flush down 75 cents a share. And I'm like, golly, unbelievable. So, you don't always catch a 75-cent dollar share winner, but it seems like it's pretty easy to catch the loser, especially when you have a big spread. That's what really amplifies the risk on these. So I'll just pull up the whiteboard here for a second so we can kind of talk about this. So, when we have something like rent, just for instance, capitalize it, RENT, and you've got a 24, 15 on the bid by 24, let's just say 65. You've got a solid 50-cent spread there. What I'll tend to do is I'll look at this. I'll start seeing green coming in on the tape, right? So I'm looking at the green on the tape and I'm like, okay, here we go. There's people buying here. I'm looking for this to squeeze up to. I jump in here and I'm like, I think this is going to go 25. But let's just say it does go 25. It goes up to $25 on the offer. The bid maybe catches up, let's hope, to at least $24.50. Maybe it goes to like $24.60. Then I'm only break even. It went up for 35 cents, but I'm only break even because I got in here at 65. So now this is the bid. And now this is where we got that first kind of pop up to 25. And now we're pulling back and we're like, okay, can we punch through 25? And if we can, then we're looking for 25.50, 25, 26, 25.75, something like that. We're looking for that bigger move. But if we don't, then what ends up happening is, especially if I end up adding right at 25, now my new cost basis is 24, 24 like 85, something like that. And then all of a sudden, jackknife, it dumps like that. Because what ends up happening is, you've got a 50-cent spread, and then a couple traders hit the bid with like 20,000 shares. And now the bid disappears, and all of a sudden you're seeing 24.15 on the bid, and you're like, uh-oh, I'm down 70 cents a share. And then a couple more 10,000 share orders go through, and you're seeing 23.85, and you're like, are you for real right now? I'm down $1 a share. Boom. 3,000 shares, I'm down $3,000. Instant. That's how fast it happens. And that doesn't, look, we can take losses on any price range. I've clearly proven that. But I find that my bigger losses tend to be on higher price stocks because of the spread. Now, if you were always buying at the bid, then the spread wouldn't be as much of an issue. But the reason you have big spreads is because there's not as much liquidity, which means if you put your order on the bid, you probably will not get filled. So then you're not going to be in the trade at all. So that's the challenge with trading stocks with big spreads. Now, I will say that when you have a stock with a bigger spread and you're in a really hot, frothy market where things are making big moves, that's when all of a sudden, you get in this trade at 24.50, it goes to 25, 26, 27, halts up, opens at 28, then goes to 30, 31, 32, and you can get a 10-point move pretty quick. So I think the bigger takeaway is this the market to be taking the risk on those types of stocks? Because the reward can be higher. I'll definitely say that. You can get some really nice 5, 10-point moves on these types of stocks. But if you're trading them and you're only capturing 15, 20 cents, your downside risk is way higher than your upside. So, and the thing with rent was that it did have a big move on day one, which was kind of unexpected because the move began after hours. It then pulled back. And then at 9 a.m., it just punches up to 12, halts, dips down, goes to 13. And on relatively light volume, all of a sudden it was at 17. Pulls back, goes all the way to 23. And then it just came back down. Like traders, it was either you chase it or you miss it. And because the spreads were bigger, it was harder to feel comfortable chasing it. And then Friday, I ended up taking a loss on it right here because I chased it. And then, I ended up getting a couple more losses on these candles. And then finally it pulls away. I got a small trade up here. But when it pulled away, it went from 25, up to 29, which is nice. I mean, that's 4 points. That is a nice move. But then look at this red candle right there. In one candle, it gives back the whole thing. It goes from 29 down to 23 or something like that, 24. So in one candle, it's like you lose 3 points. And that was the downside risk. You catch a candle like that with full size, you're down 10 grand. So to be honest, going into Monday morning, I'm going to have what restrictions set on my account? Max share size, cap, 5,000 shares. So max size, 5,000 shares, Monday morning. Until I am up over $1,000, I will not increase that size. But I have to be cognizant that 5,000 shares of a $3 stock is not the same risk as 5,000 shares of a $23 stock. So what I really should be doing is saying, okay, 5,000 shares is my max on anything, under 10. But stocks between 10 and 20, I should probably try to cap myself at 2,500 shares for the first couple trades. And on stocks over 20, I should cap myself at 1,500 shares. This would be the right thing to do if I'm going to be honest, between 2 and 10 or whatever, $1 and 10, doesn't matter. So I think this is actually a more realistic, kind of max position size to start the day. The challenge is that it's easy for me to set this on my account. So what I do is, I don't know if I'll be able to log in here. It's a Sunday. I'll try to. So what I end up doing, log in and tapped outside hours. So I can't. But anyway, it doesn't matter. So there's a place where I can go in and I can set my cap, and I'll set it at 5,000 shares. And that means if I even try, the order will get rejected. But I'm not able to. It's not sophisticated enough to, add this degree of parameters like, oh, it's this width for this, this for this. It'd be great if it was. That would add more, that would be great if it had that, but it doesn't. So that means I have to remind myself and have the presence of mind to, be very disciplined when I see something over 20, like, whoa, slow down. First trades of the day, just break the ice, go small. If you get your first $1,000 of profit, then we can take off the restrictions. But even then, I have to ask myself, is this the type of market where we're likely to see something like this make a huge move? And right now, the answer is no. But the other thing that's difficult is that things can change on a dime. And next thing you know, Monday, we have something that goes from 20 to 80. Even though the climate's kind of not suited for it, it could happen. But of course, if the whole thing happens with big spreads, then regardless, it would have been hard to manage risk. So if you can't manage your risk, risk comes first. Number one is risk. And if you can't manage risk, you shouldn't take the trade. And you're not missing anything if you weren't able to manage your risk. So risk is first, profit is second. Focus on the process, not the profits. So starting Monday, I'm going to have those restrictions on my account, more or less, certainly the cap of 5,000 shares, focusing primarily on stocks under 20. Over 20 just hasn't been as good for me recently anyways. And I have to be a little bit careful on stocks that are at the higher end of that range and just break the ice a little bit more cautiously. So that's my plan for Monday. I'm going to be focusing on stocks that have breaking news, stocks that are moving higher. I'm going to look for the highest rate of change and try to figure out what is the most obvious stock today, because that's the one I want to trade. I don't want to trade something that people aren't paying attention to. I want to trade the most obvious stock in the market. That's where I'm going to find success. That's what worked best last week. And the problem on Friday partly was that there wasn't a super obvious one, at least pre-market. Rent, well, it wasn't even on the gap scanner. I mean, well, maybe it was, but it was only gapping up like 3 or 4%. Actually, it might have been even gapping down at the open. I think it was, because that was the close. So it really wasn't even a gap, which means, yes, there were people that were paying attention to it because they were remembering it from yesterday, but traders are like goldfish. We have zero memory. So, if a stock is not moving right in front of us, we've already forgotten about it, unfortunately. And that's just the way it is, because the collective mentality is to trade what's moving. And that's the right approach. But when you pull up a stock like CADL and you're like, oh, this is a great daily chart, I think it's going to, you're overthinking it. Traders aren't smart enough generally to remember this. Now, look, there will be times where you have some really good continuation and traders are going to be still dialed in on it. But the fact is, even when you have a great catalyst, people forget about it and they move on to the next stock that's really strong. So I try to pay attention to what the herd is focusing on, the herd of traders collectively. Even if I don't like it, it's what they're focusing on. That's where the volume is going to be. That's where we're going to see better resolution on patterns. So I might think that this CADL is a great setup and I love it, but if no one else sees it, if no one else likes it, they won't buy it. It's not going to happen. So you got to kind of pay attention to what other people are focusing on. And I think that's one of the things that is important to recognize about trading is the degree to which sort of the collective sentiment in trading affects individual days, right? What people are focusing on, if people are feeling confident, if people are feeling a little nervous. And if you're totally isolated, you're not in a community, you can gauge sentiment just by watching relative volume, but it is always helpful just to see what are people talking about? What are people saying? Because that's, being able to predict those kind of human emotions is going to give you, a little bit more insight into the way things may trade on any particular day. So anyways, that's it for me. Hope you guys enjoyed this game plan for the week ahead, and I'll see you bright and early live streaming on Monday morning for all of our Warrior Pro members. Okay, I'll see you guys tomorrow morning.